Ladies and gentlemen, I say, man, the stock market has broke all-time high for S&P 500 and the Dow Jones Industrial Average. And then after that, market goes down a bit, right? Most likely, you go up again and go down, go up, go down. So where does this lead to? So important for me to share with you where I think the trajectory of the stock market will go by looking at the history of the stock market when there was a interest rate cut, okay, in a similar context. Let's watch on, shall we, all the way to the end if you want to know the conclusion. Ladies and gentlemen, the stock market is at an all-time high right now. S&P 500 has broke through 5,700 points decisively, and it's on a trajectory that seems to be going up. Now, it seems to be weakening occasionally here and there, and then go up, go down, go down. So a lot of people cannot tahan this volatility. I think it's important for me to share with you again by looking at history where the trajectory is going. As usual, these are my usual disclaimers, and let's go. So yesterday, the S&P 500 and Dow Jones Industrial Average broke through all-time high. The S&P 500 hit a high of 5,713 points, and that's a remarkable performance. Dow Jones Industrial Average also hit an all-time high as well. The Nasdaq also went up, although it's still not the all-time high, and that's all because the interest rate cuts has spurred on a euphoria in the entire stock market. The Nasdaq and the Russell 2000, especially the Russell 2000, which comprises mainly of the smaller companies, also went up. So this is a case where the entire ocean level just rise and everything floating on top just float higher. Good news, right? Well, let's look at what it is today. Today, as I record right now, the S&P 500 and NASDAQ start falling again. So a lot of people say, if it goes up, it must go up all the way, right? Why go up, go down, go up, go down, go up, go down? No, so we're not sure whether it's all good news or bad news. And I think it's important for us to come to the realization that that's the nature of stock market. A lot of people say, Mr. Loo, you always roti prata, you one time say the market is going up, flip again and say one time it's going down. But that's the nature of the stock market, right? That's the nature of stock market, where we have to address why does it go up, why does it go down, but more importantly is to look at the long-term trajectory, where is it going, which is what I attempt to share with you today. Before we move on any further, remember my updates are quite timely in the stock market. So if you want to hear my updates, please remember hit like and subscribe and follow us very closely for real-time market updates. With so much market volatility, what's going to happen next? I've came with a very special technique to understand where stock market will go by looking at the past in a similar context of history, and then we can take a chapter from there. Now, a lot of people say, but Mr. Loo, what happened in the past may not happen again. That is true, but whatever happens in the past tend to rise in the future. The key thing is to be able to see whether the macroeconomic context is the same. And generally, the outcome is also the same because I realize that human nature don't change. Their behavior don't change a lot. So whatever happened in the past tend to happen in the future as well. But let's watch on, shall we? Well, I showed this chart before. Now that the interest rate cuts have materialized, it's good to revisit this again. This chart shows the total S&P 500 total returns after an interest rate cut. So the date of the interest rate cut is here, and then it shows the S&P 500 movement from first year, third year, and fifth year. It also matters whether the next 12 months from the first cut, whether there's a recession or not. The conclusion is, of course, that by the fifth year in the long term, S&P 500 will go up, and pretty strongly for most of the time. But in the short term, the midterm, you tend to see S&P 500 having different behaviors. And that's where we need to take a look at the precedent to the interest rate cut. So if the interest rate cut happens and following that there is a recession, generally there's a chance where you will see some negativity in the S&P 500 return. But if there's no recession after the first interest rate cut, the returns of the S&P 500 tends to be higher. If you look at this, you will see. So this is the S&P 500 after the first rate cut. You'll see the average return after the first year is about 15%. The median is 17%. And the win ratio means that the likelihood of a positive versus a negative is about 86%, almost 90%. Conclusion is, if what follows after is not a recession, there's a good chance the return rates for the first year will be 15%. If you look at the average, and the median is about 17%. And there's an almost 90% chance of that happening. In the event that there is a recession that follows, then the returns will drop. By how much? Well, not a lot, but it's enough to be significant. It's about 11% for the average and median. And the win ratio, that means positive versus negative returns, is about 65%, 64% to be exact. But let's extrapolate that to the third year. By the time we reach third year, in the case of a non-recession, meaning after rate cut, there's no recession, the gains go up to 40%, 40%, 86, and the win ratio stays at 86%. And in the case where there is a recession that follows after that, the returns rate are lower, but not a lot lower. And the win ratio goes up significantly by 82%. And by the time we hit the fifth year, the average return is some significant, almost a doubling of the index. And in both cases, the win ratio is about 100%. What does this mean? It simply means that after a rate cut, hold long enough to see 5 years, you generally will see a positive return. And if you want to predict whether the next phase of our rate cut will go positive or negative, then you have to predict whether there's going to be a recession or not. Let's go deep dive further and take a look at the case when there is a cut followed by recession, and there's a cut and followed by no recession, because the returns are quite different. Let's start with the cuts with a recession first. This is the most infamous Volcker's Bear of 1982. This is where I made the most money by just looking at this chart. And I told everybody from 2022 to now, please take a look at this chart and they will tell you where we will go. And indeed, right, from here to here, the whole stock market was going down, going down, going down. And then the recovery was a phenomenal exponential rise. But interestingly, the interest rate cut of this period coincided with a very significant recession, with unemployment rate hitting 10%. This is a case where there is a recession after interest rate cut. So after the interest rate cut in 1981, there was still a somewhat downward trend. This is where there's an interest rate cut somewhere around this period, about 1982. So the Fed funds rate, which was very high, okay, at 12%, has gone down significantly to this level and then gradually go down as well. But the interest rate cut happened significantly at this period, mid-1981 to end of 1982. So what happened to the stock market after the interest rate cut? Well, after the interest rate was cut, interestingly, the stock market still continued to go down. And this is not difficult to understand, is because there is a recession going on. When there's a recession, you don't expect the stock market to do very well, right? But fortunately, after 12 months later, you actually see the whole stock market recovering very well. So the interest rate cut was a reaction to two things. Number one, inflation is now falling. Number two, there was a serious recession, which means unemployment is quite serious. The interest rate cut is to fight unemployment at that point in time. We don't really have this problem right now. Another interesting case study was the 2007-2008 global financial crisis, where the interest rate was cut from a high of 4.75 all the way to 2%. In this period was in reaction to one of the worst global financial crises that we've ever seen since the Great Depression. And guess what happened to S&P 500? Of course, the S&P 500, even with the interest rate cut, just went down by almost 50%. It is basically telling you that the interest rate cut was important, but was not enough to cause the overall stock market to turn optimistic. So this one is something that we all need to know. In reaction to recession, interest rate cuts are not viewed very important because people tend to look at the economy much more importantly. And interestingly, even with the second and third and fourth interest rate cut, it took about 5 years for the stock market to recover. But fortunately, we are not in such environment right now. We're seeing interest rate cut that has a recessionary background. Let's take a look at interest rate cut that has no recession background, shall we? One of the interesting circumstances was 1984, when interest rate cut was in reaction to address a weakening economy, but not a recessionary economy yet. So let's see what happens then when the Federal Reserve cut the interest rates. Just look at that. After they cut the interest rates, the whole stock market rallied significantly again and again and again, right? This one is very positive, and we see what happened in the second rate cut. It also went up significantly as well. This one is a very good news because it's somewhat similar to what we have right now. I would say that this one is worth reading a chapter from if you want to predict what's going to happen in the near future. Another very interesting interest rate cut was in the mid-1995, and where the interest rate cuts was about 0.75. And let's see what happens to the stock market. After the first interest rate cut, the whole stock market just rallied and rallied and rallied and rallied and rallied. 1 year later, it went up by 19%. That's very significant, right? And this is a case where I don't think there was a recession as well. So it's a very positive to see that, when interest rate cut followed by no recession generally leads to a very significant upturn in the stock market. Can we conclude that right now we're going to see a trajectory of a stock market going up? I would say yes, with some caveat. In the past, maybe the stock market were less predictive because the stock market is less efficient. People don't have phones to check, people don't have computer to check, people don't have TV to check in a more real-time way, and a lot of analyst reports are not there they can read. But right now, a lot of all these market movements, everybody can read it real time. Therefore, I would say that quite a lot of the market upswings has been anticipated and somewhat priced in already. In the short term, it will likely turn volatile, can go in either direction. But I think mankind is still mankind. Human psychology is still human psychology when it comes to the stock market. In the long term, I think that will be okay. The stock market is still likely to rise in the long term. When I say long term, it's not the next 3 months, not the next 6 months. At least 1 to 5 years is a trajectory I'm looking at. Fortunately, we're right now in a situation where I don't think there's a recession risk coming. There could be, but I don't think it's high. And the win ratios, remember, was 86% is in our favor. So let's talk about chances. Chances are in our favor that stock market will rise, follow this interest rate cut. And remember, this is not just one interest rate cut that is in the bag. There are going to be much more interest rate cut according to the summary of economic projections. They're going to be at least another 0.5% cut this year as well, and then followed by a lot more next year. So I think that this will be generally uplifting for the stock market and even the bonds market as well. But today, a very interesting report came out. The GIC Chief Investment Officer, Jeffrey, something his name is very difficult to pronounce, has warned that the market exuberance that we are seeing right now could be short-lived because there could be rising inflation. He said, for now, let's enjoy it, but be prepared that you have tight labor markets across US, Europe, Japan, and the risk of inflation coming back sooner could be there. And he's also worried that with a US election cycle underway, politicians generally like to push unnecessary stimulus into a market in an effort to win votes. And when you stimulate the demand, you push up prices as well. So we warn that there's a chance of reinflation. Okay, reinflation. Is that a real concern? I think yes. Okay, yes. But I think the chance of that happening in the near future, I think will be quite small. So all said and done, I do think that history will repeat again in the next 5 years, that we'll see positive returns in the next 5 years with quite a lot of volatility in the near future. But I'll just hold on to whatever stocks I have purchased and probably not let go and just enjoy the ride forward. For those who have made money, congratulations. Those who haven't invested, let this be a learning lesson for you so that you know how to react in future. Thank you, and I'll see you in a day or two. Bye-bye.